What is going on, everyone? This is Michael from GPURisers.com, and today is our second video in a series of videos on how to start a cryptocurrency mining business. Now, in today's video, we're going to go over income. And for this situation, the income will be the mining proceeds that you get for using your graphics cards or ASIC miners to mine cryptocurrency. So a lot of people ask, how is cryptocurrency taxed? And a lot of the things that you find out there really touch on the idea of how it is taxed when you're trading cryptocurrencies. But I'm here today to answer how it's taxed when you mine cryptocurrencies. Now again, I'm going to use the same disclaimer that I used in my previous video. Everything that I express and say in these videos is how I run my business. Please do your own research. That said, everything expressed in this video is not financial advice or legal advice. So that said, let's go ahead and move on. I'm going to use some examples here to try to help you guys understand how the cryptocurrency mining is taxed. Let's use this rig right here for an example. This rig is a 12-card 6600 XT rig. Now, for simplicity purposes, let's say that this rig generates $1,000 a month. Now, that $1,000 a month is your income, but it gets a little bit more complicated than that. See, when you're mining, unless you're solo mining, of course, 99.99% of people will be mining through a pool. If you're mining on Nanopool, Ethermine, Sparkpool, any of those, then you're mining on a pool. Each of these pools have a different threshold for payout. Many of them, you could choose what your threshold is. Let's say you choose a threshold of 0.1 Ethereum. So again, for simplicity reasons, let's say you're mining along with your rig and you get paid out 0.1 Ethereum a week. The second you get paid out that 0.1 Ethereum, that is now income. Now, regardless of whatever wallet you use, if it's a Ledger, an Exodus wallet, MetaMask, a Coinbase, or any other brokerage account that accepts that payment from the pool, the second that that payment hits, that is now your income. So if you were to accept the 0.1 Ethereum, sell it immediately, then your tax will be ordinary income. You received the 0.1 Ethereum and you sold the 0.1 Ethereum right away. So let's say 0.1 Ethereum is worth $100. You will now owe tax on that $100. Now, of course, in making that $100, you will have deductions and operating costs and everything like that, and we will go into that in the next couple videos. However, for this video, we are only using the income numbers. Now, the next part I'm going to talk about is really where the tricky part comes in on how your income is going to be taxed when cryptocurrency mining. Let's say you get paid out that 0.1 Ethereum and it's worth $100. That means the total Ethereum price is worth $1,000. Let's say your mining payout comes on Monday. You hold that mining payout until Tuesday to sell it. The price of Ethereum then goes to $2,000. Now, your 0.1 was worth $100, and now at the time of sale, it's worth $200. So in this situation, you will owe tax on the $100. But additionally, you will owe what's called short-term capital gains on the additional $100. Because of this pause before selling, it is two different transactions that are taking place. So short-term capital gains here in the United States are taxed as ordinary income. So in this situation, you sold $200 worth of Ethereum. It's 25% taxed at $100 and 25% taxed on the gain between $100 and $200, which again is $100. So total, that would be $50 in tax that you owe for this transaction. Now, if you sell once a week or once a month, you might think, okay, that's not that complicated. Whenever I sell it, because it's short-term and also ordinary income and they're taxed the same, that's just what I'll owe. And the reason why you have to split this up is because if you reverse that situation, if you mine out $100 worth of Ethereum and then you wait one day and that $100 is now worth $50, so you owe tax on that $100, but then the second transaction there, you have a loss of $50. And both need to be recorded separately. As much as we all want cryptocurrencies to skyrocket, that's not always the case. So if you're looking at your mining payouts at the end of the year and you're paying tax assessed on when you got paid out and not also calculating any losses that you might have, you might be losing out on some tax benefits. Alternatively, if you have a gain, you might then be reporting it wrong if you're just reporting the amount that you were paid out on the date that you were paid out. I hope that I'm kind of making some sense of this. The best way to understand this is breaking it out into two transactions. The first is ordinary income when you're first paid out. The second transaction occurs right when you're paid out to when you sell. And whether or not that second transaction is a gain or a loss depends on when you sell it. Now, real quick, I did mention short-term capital gains. So if you were to mine that 0.1 Ethereum, hold it for 366 days, and then sell it, then you'll owe ordinary income when you were first paid out on that 0.1 Ethereum, and then instead of being assessed a short-term capital gain, you will be assessed a long-term capital gain tax on that 0.1 Ethereum. Now, the advantages to long-term capital gains are that they are assessed a lower tax than what your ordinary income is taxed at. So I'm going to use the 2021 tax rates for long-term capital gains as an example here. So the long-term capital gains is 0% if you make under $40,400 a year in the United States. If you make $40,401 to $445,850, then your long-term capital gains tax is 15%. If your income is over that $445,850, then your long-term capital gains tax will be at 20%. Now, when you're married, those levels jump from 40 to around 80K, from 80 to about 500K, and then that 20% hits in right over 500K. So let's go back to our example of your ordinary income tax rate being at 25%. It would be advantageous to hold that cryptocurrency if you believed it would go up for over 1 year, so that when you do sell it, you only owe that 15% long-term capital gains tax. Now, of course, you are inherently getting more risk by holding it. Much like the stock market, if you believe in a company, you want to hold that long term. If you're selling crypto as you're mining to cover expenses and everything like that, then if you sell it right away, it will be ordinary income. If you hold it and the price changes at all, then that will be that second transaction that we spoke about. So another example, back to that 0.1 Ethereum. If you say, I want to hold this for over a year, sell it for the long-term capital gains, but you end up having to sell it in 6 months to cover expenses. So let's say that that 6 months just so happens to go between 2021 and 2022. For 2021, you will owe the ordinary income on that 0.1 Ethereum, even though you're still holding it and intend to sell it 6 months later. So that first part of the transaction will be recorded in 2021, and then whether you have a short-term capital gain or a loss in 2022 depends on the price of Ethereum when you sell it. So it's important to know that although these transactions come in two, both of them could be separated out into different years. But the same theories can be applied if you do trade cryptocurrencies. However, in this video series, I am focusing on crypto mining as a business. So for normal brokerage accounts such as Merrill Lynch, E-Trade, Charles Schwab, anything like that, you buy a certain amount of shares of a stock and then you sell a certain amount of shares of stock. So all of this is recorded in the brokerage accounts where you get tax documents at the end of the year and you plug all of that into your income tax return software. Now a big question lies, if you get that 0.1 Ethereum and then you sell that 0.1 Ethereum, in theory, that's pretty simple. Being able to break that transaction into two, and you have the ordinary income, and then you have the short-term capital gain or loss. But what happens when you're getting 0.1 Ethereum every day? And then 2 weeks down the line, you sell 0.1 Ethereum. What 0.1 Ethereum did that come from? Or let's say you're making 0.1 Ethereum a day for 2 years, and you're selling randomly throughout the year. And you want to take advantage of those long-term capital gains. A year and a half later from mining, is that 0.1 Ethereum from a year and a half ago, or is it from yesterday? And I believe that that issue right there will create many problems. And as many of you guys do know, our government is ran by a whole lot of dinosaurs. So in relation to cryptocurrency mining, there really is not a whole lot of guidance, other than putting 2 and 2 together. So if you take anything away from this video, please take away the idea that there's actually 2 transactions that take place. The moment you're paid out from the pool, and then the moment between the payout to the moment you sell. And again, I know I've mentioned it before, but we will be doing a part 2 to all of these videos. And in that part 2 video, it will be me standing here, and I will go ahead and pop up your questions next to me and answer them one by one. If you see someone else ask a question that you're also intrigued, please hit that like button on their comment. We will go through as many as we can, if not all of them. So real quick, again, we do have our 2,500 subscriber giveaway going on right now. It does end December 13th, but if you go to our channel, you can find that video. It's from a couple of days ago, and it shows the instructions on how to enter that giveaway. But other than that, I hope that this video was informative to some of you. I hope that it doesn't leave you with more questions than you had when you first started it. But if it does, drop a comment down below and we'll make sure to answer them. But as always, guys, thank you so much for watching. So hit that like button and subscribe to our channel. It does help out the GPURisers team. But until then, I hope everyone watching this has a great rest of their day. And as always, we'll see you guys tomorrow.